I think a lot of people look at ARK and say, and think that we're on the defensive. We are on the offense. Yes, we feel as though the Fed is making a mistake here, and that, yes, high beta stocks, which would be our kinds of stocks, more volatile than the market, do get hit disproportionately. But something's happening now, and it's happening with Bitcoin as well, which I find very interesting. So our strategy bottomed intraday, the flagship, on May 12th. And the S&P and NASDAQ have broken below their lows. Last week, they broke below their last lows. We did not. Now, maybe I'm jinxing myself, and we will now. But our strategy has held up better since May. And same with Bitcoin. Same with Bitcoin after the volatility in May. It's held in much better. It hasn't hit new lows, successive new lows. It's in a range, much like our strategy is. During a bear market and towards the end of a bear market, our strategy starts outperforming. Why? There's a saying in our business that the new leadership shows itself toward the end of a bear market. It starts outperforming. So at the end of 0809, for example, I was at a different firm, but our flagship strategy bottomed in relative terms November 24th. I remember it well. And yet the market didn't bottom until March of 09. And in the first quarter, the market, as measured by the S&P, was down 10%. We were flat. And then we came out flying. And I'd like to think that's what's going to happen. The problem is the Fed here. And in the piece we wrote today, we said, please consider the conflicting evidence and at least debate. Talk about the risk of centralization. This is a massive risk because it's not just the Fed. It's not the Fed board members. It's probably one member, and that's Powell, who's insisting on unanimity in their fight against inflation. So what they've just done is raised interest rates 13-fold from 0.25 on the Fed funds rate to 3.25. And they're going to go to 4, we believe, on November 2nd. That's a 16-fold increase in interest rate. So if you look at what he's doing, I think Chairman Powell thinks he's the reincarnation of Chairman Volcker. Now, I was early in my career during Chairman Volcker's reign. And he was fighting an inflation that really started with the Vietnam War in 1964, April. And then in May 64 was the Great Society, all of these social programs that President Johnson launched. That was the beginning of the inflation that Volcker inherited in 78 or 79. I think it was 79. 15 years, and it was embedded. There was cost push. People had gotten used to working around inflation, demanding certain wages and so forth. So that was 15 years. By the time the Fed recognized that it might have overstayed its welcome, it was maybe 15 months. That's a lot different. And this has been associated with supply shocks every step of the way. COVID, supply chain, Russian war. It's hard to separate out. And I think the key here, and this is where I'm going to have the biggest argument with the people who really think inflation, the genie's out of the bottle. I believe the velocity of money now is going to start falling again. It actually peaked in 97, has been falling. It falls at an accelerated rate during crises. And if the velocity of money starts falling now, that M2, it looks like M2 is going to come in below 3% year over year for September. If velocity is falling on top of that, that means nominal GDP growth is flat to negative on a year-over-year basis. That's a killer for companies' profits. Now, in this environment, the reason why we would start outperforming is because our fundamentals are better. We're the new world. Our revenue growth is much stronger than GDP. And in times of turmoil and trouble, again, innovation solves problems, revenue growth accelerates. Certainly that was the case in COVID. And I think that carnage of the last, well, certainly in 2021 for us, is, our strategy being dismissed by many old timers in the industry as, just a stay-at-home COVID strategy. All those stay-at-home stocks are now going to go into negative growth, which has not happened. So it's interesting. I think the Fed is a problem. I think they're making a mistake. I think the world is paying for it. If we think there's pressure here, the emerging markets, we're going to ruin our status as world's reserve currency and I remember there was a similar situation in the 80s, but we responded to it when the dollar was causing so many problems for the rest of the world. Treasury ministers from around the world got together in 1985. There was both the Plaza Accord and the Louvre Accord, and they agreed to sell dollars and buy back the other currencies to support those other currencies and to prevent the deflationary bust that was being caused by currency implosions in the emerging markets and their debt service exploding because it was dollar-denominated debt. The same thing's going on now. And I think we're going to see more rips in the fabric of the global financial system. I think we're in a global recession, and that the Fed thinks that we have a 70s style inflationary problem. So it's come November 2nd, it will have increased interest rates 16-fold. Never happened in our history before. Volcker increased them twofold, from 10 to 20%, right? And a lot of people say, many people dismiss this argument totally. They say, come on, it's such a low base. No, that's the point. We got used to these very low interest rates since 08, 09, and a lot of swaps, and swaps were the problem in the UK, were based on the notion that interest rates wouldn't go up very much if they go up at all. And so I think we're going to see a lot more swap-related turmoil and distress out there. It may happen in the U.S. We know our pension funds aren't as leveraged as the U.K. pension funds are or have been. So we don't know where the next accident, by definition, we don't know where it's going to be. But I think, they raise again, and we'll find another rip in the global financial fabric. And so what's happening now? What are these pension funds selling so that they can be made a little more right, instead of upside down? They're selling the easiest financial instruments to sell: Treasury securities, government bonds. So that's one of the reasons we're seeing our government bonds back up. So we've got the BOE reversing. You've got the Bank of Japan and the Chinese Central Bank, PBOC, both of them are supporting their currencies. What does that mean? It means they're selling dollars and buying their currencies. So it's freeing up some dollar liquidity, and there is a dearth of dollar liquidity out there. So I think we're going to see many other central banks doing that. But I also think when the ministers meet, the G20, in November, that the odds of another Plaza or Louvre Accord type agreement are going to be pretty high, because I think that we're seeing deflation in a lot of indicators now. Commodity prices, we're seeing inventories overwhelming retailers. So I think we're going to see a lot of deflation for cyclical reasons. And then secular reasons as well. Innovation is deflationary, but good deflation. It causes bad deflation for companies that are going to be disintermediated or disrupted or destroyed.